Revenue recognition in finance refers to the accounting process by which a business recognizes and records revenue in its financial statements. The principles and guidelines for revenue recognition are established by accounting standards, such as the Generally Accepted Accounting Principles, GAAP, in the United States, or the International Financial Reporting Standards, IFRS, globally. The accurate and consistent recognition of revenue is crucial for providing transparent financial information to investors, creditors, and other stakeholders. Key principles and concepts related to revenue recognition include: Realization Principle. The realization principle, also known as the revenue recognition principle, states that revenue should be recognized when it is earned and realized or realizable. In essence, revenue should be recognized when goods are delivered or services are performed, and payment is reasonably assured. Criteria for revenue recognition. Revenue recognition typically involves the fulfillment of certain criteria, including the transfer of ownership or control of goods or services to the customer, the determination of the transaction price, and the assessment of collectibility. Timing of revenue recognition. The timing of revenue recognition depends on the nature of the transaction. For the sale of goods, revenue is generally recognized at the point of delivery, while for services, revenue recognition may be spread over the period during which the services are provided. Multiple element arrangements. In some cases, a transaction may involve multiple elements, such as goods and services bundled together. Revenue recognition in such arrangements requires allocating the total transaction price to each element based on its standalone selling price. Contract modifications. Changes to the terms of a contract after it has been established may impact the timing or amount of revenue recognition. Contract modifications require a reassessment of revenue recognition and adjustments to the financial statements. Sales of goods. For the sale of goods, revenue is recognized when the risks and rewards of ownership have transferred to the buyer. The seller no longer has control over the goods, and the amount of revenue can be reliably measured. Performance obligations. Performance obligations represent promises to transfer goods or services to a customer. Revenue recognition may occur over time or at a point in time, depending on when the performance obligations are satisfied. Disclosure requirements. Financial statements must include sufficient disclosures related to revenue recognition, including information about the nature, amount, timing, and uncertainty of revenue and cash flows arising from contracts with customers. The introduction of new accounting standards, such as ASC 606 in the United States or IFRS 15 globally, has brought about changes in the way companies recognize revenue. These standards provide a more principles-based approach to revenue recognition, aiming to enhance comparability and consistency across different industries and jurisdictions. Effective revenue recognition is not only crucial for financial reporting but also plays a significant role in assessing a company's financial performance, profitability, and overall health. It is important for companies to comply with applicable accounting standards and ensure that revenue recognition practices accurately reflect the economic substance of their transactions.